Hey guys, Denis Shapiro here from SIH Capital Group and the author of the Alternative Investment Almanac. Super excited to jump on a call with Brian to discuss many different alternative assets, including life insurance policies, tech startups, and affordable housing. Can't wait for you guys to give this a listen.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 459. A lot of people consider real estate investing to be an alternative form of investment. To traditional stock, bond, mutual fund investors, real estate can seem quite risky and exotic. But once you enter into that world and learn to mitigate those risks and find the profit potential, a whole new world of alternative investments will present themselves. I'm talking about alternative investments such as notes, ATM funds, mobile home parks, life insurance policies, tech startups, industrial properties, short-term rentals, and affordable housing communities. Denis Shapiro is the author of the Alternative Investment Almanac, expert insights on building personal wealth in non-traditional ways. And he's here today to share his insights from some of the most successful alternative asset investors in the business today. Denis, thanks so much for being on the show.
Brian, thank you so much for having me on. Looking forward to the conversation.
Tell us a little bit about yourself and your experience with alternative investments.
So my journey kind of begins when I was 14 years old. I was given a copy of Rich Dad, Poor Dad by my older brother. At first, I was a very big skeptic of the book because I felt like he was probably making more money on book tours and his speaking engagements than what the material was. But I did get out of that book at that point in my life that I should be buying assets. At that time, the only ones I could afford were traditional. I had a part-time job. So every time I saved a little money on my summer job, I would buy some stocks with it. At first, I started with mutual funds, then went down the stock rabbit hole. And I did that pretty consistently throughout my high school, my college, when I graduated. But I kept realizing that in that 10-year period that it was really easy to invest in stocks that appreciate really well. What was difficult was investing in stocks that provide consistent cash flow. And I started seeing this pattern emerge. And there were all these different strategies to improve the cash flow of your stock portfolio, like MLPs and REITs and utility stocks and blue chip stocks. But what I realized is they tend to typically underperform the regular stock market index fund. And then when they're supposed to actually provide protection on a downside, the way that the computer algorithms work these days, it took everything down. So if the stock market was down 2%, a lot of those high dividend stocks were down 2% as well. So it never provided that consistent cash flow because I remember 3 years, I owned some AT&T stock and it paid an 8% dividend. And I was like, wow, this is amazing. And at the end of the first year, it was down, the stock was down 8%. And then year two, it paid an 8.5% dividend and the stock was down 8.5%. So then what I realized is a lot of those high yielding stocks are really phantom cash flow. They're not real cash flow. So then I went and that's when I had like a moment of truth. At that time, I invested in my first private equity syndication when I was about 23, 24 years old. And I realized that because it's private, there's absolutely no volatility. So it provided that cash flow that I could actually depend on. So the first thing I ever invested in was a note fund, and it was providing 10 to 12%. And it was like clockwork for 3 years. The price of the actual underlying shares never changed. I just got my steady cash flow. And it was a world changer at that moment.
Why don't you define for our listeners what alternative investments really are? Like you wrote this book. The first alternative investment that it sounds like you invested in was a note fund. But how would you describe alternative investments to our listeners?
This was an interesting paradox that I had while writing the book, is that I realized there was really no good definition for alternative investments. If someone's only familiar with stocks, almost anything to them would be alternatives that's not on the stock world. And then what I realized in the alternative space, the definition of alternative is very, very unique and centric. So it all kind of depends on who you were speaking to. But the easiest way I found to define it was basically an alternative investment is basically any privately traded investment that it had nothing to do with the stock market. It wasn't publicly traded. And there are hybrid versions, like a REIT, for example. A REIT underlying asset is real estate. However, it is traded on the stock market. So in that case, I would actually say that REIT is not really an alternative investment. You're just getting a different type of public security. But when you go out and buy a single family home or invest in a syndication, at that point, you're making that leap towards alternative investments.
What was it that prompted you to write this book? I mean, what were you looking for or trying to uncover when you wrote your book on alternative investments?
I was just trying to create this connection because I was noticing that there was this huge gap between what traditional investors thought alternative investments were and what they were in reality. A lot of times traditional investors thought that all alternative investments were like big Ponzi schemes out there. Like while Bernie Madoff didn't happen, or, Enron and WorldCom, where only scams were only limited to private. But the truth is, a bad apple is a bad apple. And then on the alternative side, I realized that I still had a sizable stock portfolio, even though I've invested heavily into alternative investments. And I think there's a world where you can have both in your portfolio. The problem is if you speak to a financial advisor and they're about assets under management, they actually don't probably even understand the PPM. So they're just going to say, oh, that's too risky to invest in an apartment building. However, if you talk to a person who only invests in apartment buildings and say, well, why don't you own, an index fund? And they're like, oh, my returns are just so much better on the syndication side. So I felt like there was a disconnect between like, hey, there's actually pros and cons to both. In terms of appreciation, it's hard to argue with an index fund. Long term, 100 years since the Great Depression has produced 8 to 10% returns consistently. And then on the alternative side, there's no argument that, hey, having a private, non-volatile asset is also really beneficial for your portfolio.
Do you have like concrete metrics? Because you hear reports that, hey, over time, the stock market has outperformed real estate. But then what real estate are they really talking about? And then, then I hear the reverse of that, which is real estate always outperforms the stock market. What did you discover?
So what I discovered while writing the book was that usually stock returns kind of average out between what inflation is and the earnings growth is. And that comes out to be about 7 to 8%. Now, there's a big asterisk to that, right? Did you do it in a way where you didn't let your emotions, was it a set it and forget it? That's where you realize the full 7-8%. And then if you not time the market, but add to it when there's a big correction, you're probably doing better than 7-8%. But I think it's safe to say that the stock market since the Great Depression has produced about a 7 to 8% return. And then on the flip side, on real estate, it's probably an extra 2 to 3%, like 9. Now it is very, very tricky because obviously there is different classes of real estate between class A, B, C, D, and there's risks associated to it. But I think it's a couple of percentage points higher. I get kind of like one of the things that I've learned in the space is that I get really turned off when I see the high projected returns because it just doesn't like, there has to be this like almost like BS monitor in your head. Because if you look at the greatest ever investor of all time, well, arguably the greatest ever is Berkshire Hathaway, right? And their average annualized return is 16%. But then you'll go on Facebook and you'll see ads for a bunch of real estate deals that can produce you 20, 25, 28%. Like you got to have some kind of like, hey, something is not 100% right with those offerings. If they could, beat Berkshire by 12 to 15% type of thing.
Why don't you take us kind of on a tour of the different types of alternative assets that you talk about in your book? And, some of the ones that I find interesting are like ATM funds, in life insurance policies, things like that. So give us a taste of some of the different alternative investments that people don't even really think about.
I'll preface it where it's probably not a good time for ATM funds. There was a major operator, and it looks like their business plan is on hold, and there's a lot of chatter of whether or not there's smoke, where there's smoke, there's fire type of thing. So I'll hold off on speaking about ATM funds. They were a very reliable source of distributions for like the last 20 years, the specific type of fund. But since that's on hold right now, I'd rather not say anything either way on it. But life insurance policies are very interesting. A lot of people don't understand that there was a famous Supreme Court decision in the early 19th century that basically made life insurance policies private property. And there's a period, right, where you cannot sell life insurance, period, but it's state specific, but usually it's 1 to 2 years. And once you're out of that period, you could go ahead and sell your property. The famous Supreme Court case was the guy had needed surgery, had no way of paying for the surgery, so the doctor accepted his life insurance policy as kind of collateral for the thing. He performed the life insurance. The guy lived a couple more extra years, passed away, and then it went to the Supreme Court. And basically they ruled that this is private property. So there's many different types of life insurance investments, but the ones I wrote about in the book were two specific. One was using life insurance policies as a like a banking system where you kind of create your own bank type of thing, and then you would take that money and then fund other alternative investments. So that's one, and that relies on a whole life policy because it relies on a very, very heavy cash flow, a cash value, not cash flow. So in situations like those policies, they're structured in a way where you maximize the cash value. So for example, if you have a $100,000 policy, within 5 years, you could access almost $100,000. They're kind of geared towards that, but it's a very high premium every single year to get to that number. Now, the second type of life insurance investment is called life insurance settlements, and that's where you actually purchase the life insurance from someone else. Usually, you're actually purchasing term, not whole policies, and they're usually very specific age groups. The companies that are involved in this space will usually only buy from someone who's 89 years old or 90. They'll average out a portfolio of 91-year-olds. They have a certain metric that they look for, because what ends up happening is on the actuary tables, once you hit like 91, statistically speaking, there's like a 90% chance of death within the next like 6 years. So they focus on a very specific time group. They'll buy it. They'll raise a certain amount of money to pay those premiums for those next 6 years. And then the returns are kind of baked in. It's only a matter of time till they start paying out. So those are the two life insurance related investments that a lot of people I don't think realize are available. They're not standard. They're not cookie cutter. They have their nuances. But the good thing is who's paying them is these companies, life insurance companies, who have a way different standard of capital balances that they have to keep. So, for example, with the bank fractional system, there's only a very small percentage of cash that's actually kept in the actual bank itself. But however, with life insurance policies, that percentage is much, much greater. And there's like, if it's a certain rated life insurance company, it's very, very rare, if ever, have they actually gone out of business. So a lot of these life insurance companies that would be paying you those premiums have been around for hundreds of years.
What are some of the other alternative investments that you discovered through writing this book?
Our favorite is, and this is what we actually do, is multifamily. That's kind of, I call it the holy grail of alternative investments. And I also call it the gateway kind of drug to alternative investments. Once you start getting into multifamily, then what's going to end up happening is once you understand it, it's very easy to apply what you learn with multifamily to other asset classes in commercial real estate, such as mobile home parks and self-storage and anything else, because they use the same terms. Usually it's the same group of, cap rates, IRRs, cash on cash, all that. Once you start realizing it in one sense, you could apply very easily to all these other alternative investments that are very, very similar to multifamily. We did a chapter in tech startups, but that's just because we have a pretty large network, and some of our investors that we have grown really strategic relationships with, that's their field. So we'll invest with people. A lot of times, like what I've learned is the people are way more important than the product. So we have our relationships where we'll do some tech startup investments.
You mean the tech startup founders and the people running the business are more important than the actual product that they're
100%. Yeah. Well, it's like, well, would you invest in whatever Elon Musk comes up with next? Or would you invest with two new graduates that have a great, amazing idea? But the truth is there's that proven track record of success that they know how to do it from start to finish. So we have a couple of relationships with that space. Otherwise, we really just try to stick to real estate.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
Let's talk a little bit more about tech investing, just because we haven't really talked about it on the show. And I'm always fascinated by the difference in mindset between the person investing in tech and venture capital or through venture capital funds and their expectations of returns versus those who invest in real estate like multifamily. Can you describe some of those differences?
And you know what? It's like how I previously was discussing why I kind of gravitated towards alternative investments, because I was looking for that cash flow. When I was having these long conversations with our tech partner, we started realizing that on the commercial real estate side, you're probably going into a deal, if it's properly structured with the right team and the right financing in place, you probably have a 90% chance of some kind of success. There might not be a home run, it might not be a 20% return, but in general, there's a lack of housing in this country. As long as you're not really in a war zone, there's going to be a huge demand, and as long as it's priced accordingly and you have a modest business plan, you have a high chance of a reasonable return. Now, tech startup is almost that, completely flipped. They like to call it the long tail model. So a lot of times the tech startups would be a flat line to a certain point where they reach a certain scale, and then it could shoot up like a hockey stick. So you might only have a 10% chance if you're betting with the right people but then the returns could be a 10x or a 20x. So you might have 10 deals that completely you lose all your money in, but on that one deal that hits, you're getting such a great return. So it is a very interesting complement. Like when you introduce it, like by all means, if I have a portfolio, it's not even 50-50, but it does make sense to allocate maybe 5% or 10% of your funds into these potential 10x, 20x, 30x type of projects.
What really strikes me about tech investment, and it's such a different mindset, is there's really no expectation of cash flow. It's really more about the exponential payout at the end if there's a successful exit. And 9 out of 10 of the investments you make in tech are expected to fail, and you may never see any of your money. I mean, how do you view that mindset? I mean, is it really gambling, or is there really like some actual numbers that back up, okay, your success ratio will actually be profitable in the end?
What we became comfortable with is the fact that we think we could stack the deck somewhat to a certain extent. We've not coined, but we're really big on this term called relationship driven investments. And we sometimes, our core investment is affordable housing, which is as safe and cookie cutter and probably the complete reverse of tech startups in this world. But what we've learned is that, yes, if you go on, let's say, a crowdfunding website and you pick up 10 random startup investments, you're absolutely right. You'd be lucky probably to hit 10% success rate, right? Because you have no relationships. You have no idea they'll give you a really fancy presentation and you'll be your bios and you'll see, Ivy League educations behind them, but you'd be lucky to hit your 10. However, if you spend 2 to 3 years getting to know one founder, and then you invest with that one specific founder, and because you know their pedigree, you know what their family structure is, you know their lifestyle, you know all of this stuff, you know how hardworking they are, you know how driven they are. All of a sudden now your 10% chance becomes 11, 12. And if you could stack the deck and then he can introduce you to 9 other people that are similar driven to him, all of a sudden now you're stacking the deck, because now you're not just investing with a fancy presentation or a fancy data, like a fancy, web platform. What you're investing in is the people. And if you could invest in 10 really motivated, really smart driven superstars that were referred to by other superstars, you can really stack the deck, and that 10% number can be a lot higher, to a point where now, as someone who's very risk rewarded in every decision almost that he makes, now I start feeling more comfortable because it's not anymore 10% anymore. So that's kind of what we say to that. Yes, absolutely. If you just do it blindly and you're not going to put in the time to create that meaningful relationship, then you are absolutely worse than a coin flip. But if you're going to spend that time and maybe, as a real estate operator, whatever it is, you come into circles with some promising startup guys that you can foster a relationship with, then that's when I kind of recommend, maybe that's when you put tech startups into your portfolio.
You mentioned affordable housing as one of your niches there. Is that something you're investing in, is affordable housing? And what does that look like?
Our company, SIH Capital Group, so we have a few different divisions where we have our own partners on those specific divisions. One of them is affordable housing. That's actually how we got started. Just someone we built a relationship with 5-6 years ago. He was in that space, and the more he told me about it, the more we want to get involved. And then we worked on a project together that went really, really well, and we decided we wanted to kind of merge companies. So we have a pretty robust affordable housing division. We are now in 3 states: Pennsylvania, Virginia, and Ohio. We're located out of mainly Pennsylvania. I'm actually the only person not in Pennsylvania out of the Affordable Housing Partnership team. And then we have a hospitality brand as well, where we have properties on the Jersey Shore that is a completely different business model. So we see 2 very interesting clients. We have one that's as price conscious as you get, and then we see one that spends pretty liberally on an experience. So it's interesting to see both sides of it.
And when you talk about affordable housing, what exactly does that look like in your portfolio?
With affordable housing, when we refer to affordable housing, we mean affordable housing at scale. Usually that's a LIHTC property and some form of compliance. So what I like to explain to people is that if you have a raw piece of land, the cost for that land is surprisingly similar, whether or not you're building a brand new Class A building or you're going to build something affordable. So what happens is no developer in their right mind would ever go ahead and just build affordable out of the goodness of their heart. What they do is they go to the government for these LIHTC credits that bring down the cost to build that brand new building so that they could make it affordable. Now, the government doesn't just give you a check. They put 2 compliance periods on it. These compliance periods usually last 15 years, and 15 years combined, that's 30 years. So what we will do, we're not developers. We don't like the development space. We will buy in one of those compliance periods, and then we would see it to go to market rate after that, or we will renew at that point and put on additional compliance on it for certain incentives that we would get. So a lot of times we are dealing in secondary and tertiary markets. So it's not like, hey, the rent there is $2,500, but we have to suffer for $1,100. A lot of times we're getting the same rent or even sometimes better rent than what that local market would demand. So it's a very interesting market. There's usually waiting list. We hardly ever advertise for our properties. Our average occupancy is in the high 90s, and we keep it there. Usually when we do rent increases, a lot of the rent increases goes right to the local housing authorities. It doesn't even fall on the tenants. And we're very mindful of what renovations we do. We don't need to do granite countertops, all of that stuff. We just need to create a safe, affordable, beautiful place where people can have a safe place to raise their kids.
Sounds like your game plan with affordable housing really is contingent upon getting that LIHTC designation.
We would already buy the property that has the LIHTC designation. It's not like we ran them. It's its own separate niche in the commercial real estate world. It's not like it's like, oh, we would take a regular property and look to put the LIHTC credits on it. It is already a property that was already built with LIHTC credits, and now it's just in its compliance period at this point.
One of the things that I'm unclear about when it comes to LIHTC is where is the profit potential? Because you mentioned if you raise the rents, that rent increase goes to the housing authority. My understanding, it's just my very minimal understanding of LIHTC, is it's very hard to make a profit owning and operating LIHTC. It's more on the front end when you develop LIHTC that as a developer that you make your money. So I'm wondering, like, where is your profit potential when it comes to LIHTC?
It's fascinating for sure. That is not 100% wrong and not 100% right. So what happens is, yes, there is a lot of money to be had for the developers. However, when it goes into the compliance period, when we come into the picture, what we're doing is we're taking out the financing that was in place for a lot of these developers. So the funny part is these developers get these big credits. They build these really beautiful communities. And what ends up happening is then they are actually restricted on the amount of profits they can take out of that property. They have to hold on to really high reserves. You see them having their own management companies in place because you're allowed to overpay your own management companies. But at the end of the day, the property itself can't really show too much of a profit because of the compliance period. When we come in, we usually remove that financing because we're not assuming that financing. That allows us to pay off that mortgage. Then those profit restrictions come off the table. And now we're operating as a regular commercial real estate. Usually we usually come in there and our business plan is actually not really a revenue one. It's more of an expense management one. So it's not unusual. A few of our properties that we originally bought was in the high 80% operating expenses. And we would get them into the high 50s, which is more normal for a 20-year property or 15-year property. So it would be more of a operational expense reduction business plan, which I think is actually a lot easier to perform because a lot of the multifamily that you see out there, they rely on these huge rent bumps that depends if we're going into a recession, is that really a viable business plan versus our situation where it's like, hey, we're going to take the property management fee that's at 10%, which is double what's industry norm is, and we're going to bring it down to 5%. Because we actually have our own property management company, and that's more than a fair return for them. And right now, and that alone shaves 5%. A lot of times, insurance is a huge reduction. We're buying a property right now where we are reducing the insurance cost by $100,000 because they had a portfolio loan on it. And by us separating those specific properties, we got a huge savings. So a lot of it is there's these touch points that we could get into where you can really reduce the operating expenses to what I would say industry norms if it wasn't affordable housing.
Dennis, how would people find out more about you or get a hold of you?
The best way is just to go on our website, sihcapitalgroup.com, click learn more. We do have a contact form. Feel free to contact us. We don't have no investor relations person. So when you contact us, you're literally dealing with one of the general partners. Usually it's me. And if you're interested in reading the book, The Alternative Investment Almanac, you could find that on Amazon, The Alternative Investment Almanac by Denis Shapiro. It comes right up. And I always love connecting to our investors. So reach out anytime.
What is your favorite hack or app?
So I will actually give out a shout out to one of these startups that I did invest in. It's called Noplex, Noplex. It's someone that was in our network. He created a task, like an Asana type program for people with ADHD. So it's just super laser focused on only focusing on a few high word tasks a day. So you're not staring at 20 to-do list items.
Well, Dennis, it's been real interesting talking about alternative investing with you. And thanks for kind of giving us some insight into startup investing, venture capital investing, a little bit about ATM and the LIHTC information you shared is really interesting. So thanks so much for coming on the show. It's been a great conversation.
Brian, thank you so much for having me on.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIGinvestor.com.